Bitcoin just lost nearly half its value, from $126,000 down to $60,000. For some investors, this feels like déjà vu. Another crash, another cycle, another reset. But what if this isn't just a correction? What if this time something structural is changing beneath the surface? Veteran macro investor Dan Tapiero says this drop is not normal. Venture tokens are collapsing 90%. Institutions now control a growing share of Bitcoin's supply. And while prices fall, stablecoins quietly process $33 trillion in volume. So here's the real question. Is Bitcoin crashing, or is the entire crypto market evolving into something very different? Stay with us, because what's happening right now could define the next decade of digital finance. Bitcoin has fallen nearly 50% from its October 2025 high above $126,000. At first glance, this may look like another typical crypto correction, something long-term investors have seen many times before. But according to veteran macro investor Dan Tapiero, this is not a normal pullback. This represents something much deeper, a structural shift, a transition phase, a reset in how capital flows inside the digital asset market. Today, we break down why this drop is different, why venture tokens are collapsing 90% or more, why institutions now control more of Bitcoin's supply, why $33 trillion in stablecoin volume matters, and what may actually happen next. This is not hype. This is structural analysis. The 50% drop. Bitcoin peaked above $126,000 in October 2025. From there, price slid aggressively, first 10%, then 20%, then 30%, and then it didn't stop. Instead of stabilizing in the $90,000 to $100,000 range, which many expected, Bitcoin continued falling towards $60,000. That magnitude surprised even experienced investors. Dan Tapiero, founder of 50T Funds, admitted he initially expected a standard 20 to 30% correction. That would have been normal. That would have fit historical patterns. But this went far beyond that. And when price action breaks historical behavior, professionals begin asking deeper questions. Why this is not 2017 or 2021? Previous cycles followed a recognizable pattern. Retail speculation surged, altcoins exploded, leverage built up. Then a liquidity event triggered cascading liquidations. But this time feels different. The selling pressure isn't purely from retail panic. It isn't even centered around Bitcoin weakness. Instead, capital is being reallocated across multiple emerging sectors simultaneously. Artificial intelligence, robotics, precious metals like gold and silver, crypto-related public equities. This isn't just a crypto correction, it's capital rotation. When liquidity spreads across competing growth sectors, speculative assets feel it first. Bitcoin is now competing for capital, not just against other cryptocurrencies, but against AI infrastructure plays, robotics manufacturers, defense technology, and commodity hedges. That changes the dynamic entirely. Venture tokens collapsing. According to Tapiero, the worst damage is not in Bitcoin, it's in venture-backed tokens. Many of these tokens are down 90%, and astonishingly, some have fallen another 90% after already losing 90%. That means near total destruction of speculative value. Why? Because many token models lack clear value accrual mechanisms. Even projects generating revenue have no direct pathway to return that revenue to token holders. Institutional investors look at that structure and ask a simple question: where is the cash flow? If the token does not capture value, then it becomes purely speculative, and in a tightening liquidity environment, speculation is the first thing to die. This is not price correction, this is structural correction. Institutions now drive Bitcoin. More than 100 companies now hold Bitcoin or Ethereum on their balance sheets. Between 5 to 10% of total supply is in institutional hands. That is a major structural shift compared to previous cycles. But institutions change market behavior. They demand governance clarity, transparent token economics, sustainable value creation, and regulatory visibility. And most importantly, when institutions sell, they sell decisively. In 2025, ETF inflows drove Bitcoin upward aggressively. Now, some of those same vehicles are seeing outflows. Flows matter more than narratives. Bitcoin is no longer purely retail-driven. It is now partially flow-driven, and flows can reverse quickly. $33 trillion in stablecoin volume. While prices dropped, stablecoins processed $33 trillion in volume during 2025. That number is massive. It signals something critical. The infrastructure of crypto is expanding, even while prices correct. Most of that volume is dollar-denominated stablecoins. Over half operates on Ethereum. Non-dollar stablecoins barely exist in comparison. Tapiero sees this as a future growth frontier, because if stablecoin adoption spreads into euro, pound, yen, or emerging markets, that unlocks a new phase of digital monetary infrastructure. In other words, the plumbing is growing stronger, even if asset prices are volatile. Has the low already formed? Tapiero believes the low could already be in, but he also notes something important. We haven't seen a clear capitulation event like the FTX collapse in 2022. There hasn't been one defining panic moment. Instead, this has been a slow grind lower. Slow bleed corrections psychologically exhaust markets more than violent crashes, because there is no cathartic release, just uncertainty. What happens next? Tapiero's base case is not a sharp V-shaped recovery. He expects months of sideways price action, range-bound volatility, no immediate catalyst. This could mean Bitcoin trades between $55,000 and $75,000 for an extended period. Sideways markets are where long-term accumulation quietly happens. They are also where weak conviction exits permanently. Short-term traders struggle in this environment. Long-term allocators thrive. The bigger macro picture. Global liquidity conditions remain tight. Interest rates remain elevated relative to the ultra-loose era of 2020 to 2021. Capital is selective. Investors are demanding real productivity. AI is delivering measurable enterprise value. Robotics is improving industrial efficiency. Gold and silver are benefiting from geopolitical uncertainty. Bitcoin must now compete in that environment, and that competition forces maturity. What this means for investors. If you approach crypto with a short-term mindset, volatility will destroy you. That was Tapiero's warning. This is now an institutionalizing asset class. That means slower cycles, lower reflexivity, more scrutiny, more regulation, but also more stability over time. The days of purely retail-driven mania may be fading. The structural shift thesis. Here's the key takeaway. This correction may not mark the end of the cycle, but it may mark the end of the old crypto cycle structure. We could be entering institutional-dominated price action, capital rotation competition, revenue-driven token evaluation, stablecoin-led infrastructure expansion. Bitcoin may still rise in the long term, but the path may be different than previous eras. Slower, more strategic, less euphoric, more financialized. A 50% drop feels dramatic, but structurally, it may be a transition, not a collapse. Markets evolve, participants evolve, capital evolves. Bitcoin is no longer a fringe asset. It's part of global capital markets, and global capital markets are complex. The question is no longer, is Bitcoin dead? The question is, what version of Bitcoin emerges from this structural reset? And that answer will shape the next decade of digital finance.